given that now we are in a situation where lots of things are changing drastically.
All this chaos leads to a larger question. What is happening to the world order?
What is your worldview now, and how are you using that in your PMS?
Where the US is today, they might not have another option other than debase their currency. So the reason why gold has rallied so much is this entire debasement trade where people are not having any more faith in the dollar now. I mean, if someone's going to do these things, why will I have faith in him, right? What you and I need to do as investors, understand that, see, we can't do anything about the world. We can't change these things. What we can do is how we position ourselves.
How do you use quant investing, or how do you use your process to wade through the volatility?
So you want to strip down everything in terms of first principles. With quant investing, like what we really like is that there is data that you're looking at. And when you look at like say hundreds of years of data, you see that like history doesn't repeat itself, but it does rhyme in different ways. If you look at 2020, right, like when the pandemic happened, no one knew what's going to happen to the markets. But Ray Dalio tweeted, get your hands on any asset that you can today. He mentions that this has happened back in 1917 when the Spanish flu happened. And when that happened, what did the government do? They ended up...
Hey guys, welcome to the Money Mindset. Now, I keep reading all the comments and all the feedback from all of you, and one particular comment stood out for me. The fact that on the Money Mindset, we keep bringing a lot of veterans to the show time and time again, people who have been tracking the markets for 20, 30 years and who you've seen all over TV channels. So I decided to break that trend a bit and get someone who is fairly a young investor, but someone who's building a brand in the equity space. I have with me Rishabh Nahar, who is the partner and fund manager at Qode Advisors. Rishabh is a young investor. He's been in the market for over 8-9 years, and he's building a quant-based PMS. So we're going to learn from him what his strategy is, how he came into this market, and of course discuss a lot about the market itself. Rishabh, thank you so much for joining us.
Thank you for having me, Sonia.
So I've seen you all over the internet, and you've been talking to a lot of people, and you've been talking about your story. So I know a little bit about it, but tell me, how did you enter the stock markets, and what has your journey been like so far?
So again, thank you, Sonia. So I started back in 2012. So I was doing a BCom from HR, and I grew up in Bombay itself. And I was always interested in finance. I come from a Marwadi family, so we end up talking numbers on the dining table, right? Even my mom. The funny part is, in my house, my mom keeps the accounts, and my dad doesn't take care of the money. So it's like I learned a lot of finance from my mother as compared to my father. And so my mom always pushed me as a child that, why don't you understand like compound interest, and like, why don't you track Warren Buffett? So she was an investor, from like early 1990s.
Oh, wow.
And she's been like, I remember, we had these physical share certificates of this stock called DSQ software. And you must be knowing because you've been in the market since a while. And I was like, oh, you spent 3 lakh rupees on this in 1999. And she's like, yeah, it was like 100 rupees back then. And we had 3,000 shares. And after the tech bubble, it like became zero. And so that's where the journey actually started. After I got done with with my BCom, the thing with the BCom is that like you don't need to really attend college, right? So you get a lot of time to do a lot of peripheral stuff, right? So I ended up spending a lot of time doing internships. As soon as I got done with college, I took up a role as a research analyst in another PMS. I mentioned earlier, right? Girik was where I started my journey, and I got like
with Varun and
Charandeep, and I got really good exposure because it was a small team. And I did hardcore research wherein, we went to factories, understood businesses, made valuation models. And that's where my journey actually began. After I got done with Girik, the idea was that I wanted to do something by myself. And so my partner Kavan and I got together. We rented a small space, and we said that, why don't, we had a little bit of capital of our own. We said, why don't we start investing ourselves? And, just like any other investor, I think our journey started with leverage. Trading like futures, options, and all those fancy products, because we want to make quick money, right? So we started trading, and I was manually trading. Then we realized that, okay, we can't do this for very long. So why don't we learn how to automate things and systemize things? So I came across this investor called Jim Simmons. And so he was like one of the pioneers in quant investing. And I didn't have any background, right? So because I've done a BCom, I don't know how to code. So the first requirement was that, okay, I need to know how to code. So we spent a good like 8-9 months learning how to code. So, now I code in 4-5 different languages. So do like everyone in my team. And that's when I started understanding more of quant finance. And that's how like the journey into quant finance actually began. So it started with, FNO trading. and then learned how to like systemize things, how to backtest. And in 2018 is, when we actually started managing outside funds. In 2024, we launched the PMS. So today now we are like a 35 people organization.
Nice.
And
And you manage about 350, 400
yeah,
crores?
350, 400 crores of AUM. So the thought process was never to manage outside funds. Over the last 10 years, we ended up growing our own capital very well. And for us, it's all about consistency. It was not about CAGR or any of those things. It's about the journey. So when I look at the markets, I'm like, it's not about the final number. It's about, okay, fine, can you go through it without those emotions? Recently I was reading that this one of like the world's greatest traders, he mentioned that you're a successful trader when you go back home and your wife does not understand, your P&L from your face, right? Like, and I think it makes sense because otherwise, like, there are bad markets and then you have a bad year. So the idea with quant finance was that can we make something wherein we don't have major ups and downs? Can we have like a smooth equity curve? Because not everyone is like a Warren Buffett, right? You can't see your portfolio drop by 50% 4-5 times in your career and yet survive.
No, that's true. It's interesting that your mom was an investor, and that's where you got exposure. And you're lucky. I mean, you got exposure so early on in your life, right? It's not too many people have that privilege, because most people you speak to, at least in my age group, say that I wish our parents had bought into the markets instead of buying property and putting their money into FDs.
Absolutely, yeah.
So that's, I think, where it all started for you.
Yeah, I think like with my mom, in fact, she's like really passionate. I like to talk about her a lot because she ends up coming to office. She's learned how to code. I mean, she's like 65 now, right? Like, and it's not like she has any sort of, any of that background, but she's like really passionate. And I mean, not like she's doing in-depth research. Recently, she's telling me, when the silver rally happened, she's like, Rishabh, there's a big shortage. I'm telling you right now, you need to buy silver. I was like, Mom, you got to stop all this surface-based research and the speculation. Then the next day, she's like, Rishabh, you have to buy me one Bitcoin right now. I said, how do I just buy you one Bitcoin right now? But, she's so passionate about it. That's where I guess, like that's how it all started.
I can see that passion in you as well. And it's so nice to hear, because I speak to a lot of people who are in this market for 10 years, 20 years, 30 years. And I guess after a certain point, there is a little bit of hubris that settles in where you feel like you know it all, right? And I feel that is when you start making all the mistakes. You're not open to trying new things. Like hardcore equity guys, they don't want to invest in gold and silver when it's right in front of their eyes that things are changing, or they don't want to even learn about Bitcoin. No offense to anyone, but someone like you who's still very young and learning is open to these new asset classes.
Yeah, absolutely.
Right?
I think like, around me, I've seen like, so through my journey in Girik and like the people I know, I've seen a lot of people make a lot of money just through small cap and micro cap investing, right? Like most of the guests on your podcast, I know that like they own large stakes in large companies and that's how they become successful. And, I think there are multiple ways of getting to becoming rich, right? Like, so I end up tracking like different investors. So there are people like say, Ramdev Agarwal or Radhakrishan Damani, and then there is someone like a Jim Simmons and a Ray Dalio. So all the philosophies are so different, and like I think that we only understand the like the surface level that like they made 100x in a stock, but you don't know anything about their journey, right? Like I speak about this that no one knows actually why is Warren Buffett really rich. I don't think that he's rich because of his stock picking. I think he's rich because of his use of leverage, right? Like the fact that he got an insurance business and then he took all that money and invested in the markets, right? Got him to where he is today. So if you dissect the journey, there are multiple ways. I think the one thing that's common is that I don't know if it's greed or ambition, but it's the fire in the belly that has got them there, right? Like
absolutely, yeah, absolutely. So I want to understand your investment philosophy. I do know that you primarily do quant investing, but tell us a little bit about that process. And in a market like this, which is so volatile, which you don't know what's going to happen the next day, how do you use quant investing, or how do you use your process to wade through the volatility?
So what we end up doing is everything, like, so you want to strip down everything in terms of first principles. And this concept of first principles we learned from Elon Musk, right? So when he built the rocket, when he built SpaceX, he said that why is the rocket so expensive? And he stripped down everything and realized, oh, it's the battery, right? And we can actually build this internally. And so the same thing with investing, right? If you strip down everything in terms of first principles, everything comes down to a process. With quant investing, like what we really like is that there is data that you're looking at. and when you look at like say hundreds of years of data, you see that like history doesn't repeat itself, but it does rhyme in different ways. So I'll give you an example. Look, if you look at 2020, right, like when the pandemic happened, no one knew what's going to happen to the markets. But Ray Dalio tweeted, get your hands on any asset that you can today. The thing is that how can you be so confident, and as like a fund manager that that level, how can you tweet something like that, right? But later on he mentions that, listen, this has happened back in 1917 when the Spanish flu happened. And when that happened, what did the government do? They ended up printing a lot of money, and there was just liquidity in the system. So all asset prices, so you're seeing asset based inflation. So stuff like that, right? So with quant investing, the idea is that you go back in time, you figure out, different environments, you figure out that, okay, how have different asset classes performed in different environments? And then you would realize, okay, fine, this is how you can fine tune your model today. So what we end up doing is that we look at, say we, look at Indian markets. We have about 20-25 years of data. And when you're looking at 25 years of data, you're trying to see that, okay, fine, in what environment, what has done well and what hasn't done well. So we call that, we term it back testing. Right. So yeah, we actually essentially run through a back test. So something that we do is we've been heavy on gold. And, we often get this question that, oh, like, why did you invest in gold? Or did you know gold is going to go up? And I say, I did not know that gold was going to go up. And I don't even know what's going to happen from here. But if I run a back test, if I look at like, say, 20 years of Nifty data, Nifty has given us maybe 11-12% per annum. Gold has also given us 11-12% per annum. But if you mix it up, like if you had put 50% of your money in Nifty and 50% in gold, the equity curve becomes very smooth. So when I say equity curve becomes very smooth, 2008 Nifty saw like a 60% drawdown. Maybe you must have witnessed it in your career, right? And 2020 also we saw 37% drawdown. But at the same time, gold was say smooth, or gold did not see that drawdown. And there were different times when gold saw drawdowns. So that combined portfolio could give you the same return, that same 12% per annum, but with a lot less volatility. So this concept comes from Ray Dalio again, where he says that, he does this thing of all-weather investing, wherein you look at 50, the idea is that you get to 15 uncorrelated assets, and all of them will be positive at, say, the end of 5 years or 7 years, but they all have different return streams. So they're not, dependent on each other. I haven't found 15, and, I don't know how he does it. I have an idea how he does it, but I don't know exactly how he does it. But the idea is that if you can do that, you can have a positive year after year, and the journey is really smooth.
So you have an all-weather PMS as well, right? Given that now we are in a situation where lots of things are changing drastically, there's a whole new world order that people are talking about, where fiat currencies are losing demand, and we have alternate asset classes coming up. What is your if you had to wear or if you had to look through your crystal ball, what is your worldview now, and how are you using that in your PMS?
So I'll tell you like the way I look at the market. So I look at money. Ultimately, like, when you're looking at money, you have to measure everything in terms of whether you can spend it or not in the future. So you're looking at it as a store of value. So when you're investing in any asset, whether it's like, real estate or gold or equities, you're looking at, will it have the same value 10 years down the line, 20 years down, so that I can maybe spend it or pass it down to my children, right? That's the thought process. Now, if you were to measure any equity asset, I mean, any index in the world, you want to measure in terms of gold. So if you measure Nifty in gold terms, it's probably, been flat, right? Gold is also given 12%, Nifty is also given 12%. So then you ask, okay, fine, where is the return from gold coming from? Why is gold going up? So if you look at India, like MCX gold or spot gold, it's 12% per annum, last like 25 years. Even if you strip out the last 3 years, a lot of people be like, oh, why are you talking about the last 3 years? Take the ending period as 2022. 12% comes from 7% inflation, 3-4% as the currency depreciation. So it's just held that store of value for you. Now you want to measure everything in gold terms. Now, you've spoken about this earlier, like the currency debasement, right? And that's the entire thought process of holding gold. That where the US is today, they might not have another option other than debase their currency. So they're in a crisis. They hold about $40 trillion of debt, $39 trillion of debt. They're paying about $1 trillion, per annum in just interest cost. $2 trillion is their fiscal deficit. This year, they need to refinance about $8-9 trillion, plus that $2 trillion of deficit will get added. So about $11 trillion needs to get refinanced. There's no other way other than devaluing your currency, because, with what they've been doing with the world, right? They've been playing games. So now no one wants to, why will I hold any dollars? I don't want to hold any, US bonds. So they don't have another option. So when you're in a debt crisis, there are only 4 ways that you can get out of it. One is, you default on your debt. I don't think they'll do something like that. The second is you become austere, so you stop spending, right? I don't think they're going to do that because they've been spending through their nose since the last 50 years. Third way is that the GDP really expands. So there's some AI boom or something happens wherein the GDP really expands. So then the debt to GDP will get a lot better. And then the fourth way and the easiest way is print your way through this, right?
Which is what they're doing.
Which is what they will do. If you look at 2020, right? A lot of people say we've seen like the world's greatest bull market last 4 years. But if you dissect that bull markets, even India, right? Say Nifty is given 24% per annum. 2020 US balance sheet size was $4 trillion. In 6 months, they printed another 4 trillion. So what they took 25 years to print, they printed in a matter of 6 months. So all that liquidity came into the system, which is where, we've seen that bull market. So I think that like a lot of the veteran investors don't talk about like macroeconomics. And I understand why they don't, because it's very hard to act on that information or predict. But I think it's important to know that something like this can happen. And like, you need to be exposed to an asset class, whether it's real estate, whether it's equities, whether it's gold. Sitting in an FD and a debt fund probably would be a crime today.
So, even with gold, right? And I talk to a lot of equity investors. For them, I think the problem with investing in gold is gold at the end of the day is a yellow lumpy metal, right? And when you're investing in, say, a business, like you're investing in a TCS or an Infosys, the business grows. Like there are more factories, there are more employees, there is visible growth. So when you're investing in a metal, the value of that metal will be the same. Now
there's no productivity.
There is no productive use of that metal, right? Now the value is determined by how much you pay versus how much I pay, and demand, supply, or whatever. So I think that is where that hesitancy to, buy excess gold, because then your judgment comes into play that then, if it's just something that you just buy and keep, why do I need so much knowledge? Why do I need so much intelligence? So that's an argument, of course, for another day. But so, okay, tell me. So now if you have 100 rupees, right, at this point in time in 2026, and if you had to do asset allocation of those 100 rupees, how do you do it? I know the traditional way of doing it, but what is your way of looking at it in 2026?
So I think there are only two asset classes that you could really invest in as an investor in India: equities and gold. I don't think real estate is out of reach for most people. There are too many hiccups, and I don't even think it's a good investment in any way. But if you were to look at these are the only avenues that are available. Now, gold could be like a percentage of your portfolio. I'm not saying that needs to be a large part of your portfolio. The reason why I'm such a why I insist on gold as a part of the portfolio is because it reduces the volatility in your entire portfolio. So from the quant lens, right, I understand there's this entire lens of productivity, and this comes from Warren Buffett's school of thought that, take all the, gold in the world and it'll become one big cube. And he's absolutely right. I don't think he is wrong. But I think that we are in this era of fiat currency wherein, fortunately, unfortunately, this is the reality, right? This is how central banks work. If that changes, then we could change our thought process. But gold needs to be a part of your portfolio. It cuts down on the volatility of your portfolio completely. So if you look at your portfolio in risk-adjusted terms, see, a lot of the veteran investors don't look at it in risk-adjusted terms, right? It's all about CAGR. I invested 1 crore today. Will it become 10 crores in X number of years? I think the journey matters a lot, because especially when you're handling investor money, what happens is that, if you see prolonged periods of drawdown or time-based corrections where your funds have not moved, you start getting frustrated and then you start taking the wrong decisions. Now, you can't prime the investor. Can't tell him that, oh, you need to believe in me, have faith in me, I'm the right person. Ultimately at 3 years, he's like, you've not performed. Right? So you want...
And I don't know why 3 years is a spot where people lose their patience, right? And honestly, you need to wait for at least 5 years for a mutual fund. I've always noticed this. Every 3 years, people will, like, retail investors just stand up and be like, what, my performance has not happened in the last 3 years.
Yeah, I guess it's like, it's hard, especially when you're on the outside. I understand that, right? Like if you're handing over funds to someone, you only know so much. You only know from this conversation with Rishabh, from this 1 hour conversation, what he does. Right? You have no idea what I do through my day, what is the research process, and how much ever I communicate, there's only so much you can do. So after a point, you come like, okay, I don't know what's happening. And then there's also this fear of missing out, because the way, PMS's mutual funds work, there are hundreds of them. So there's going to be a survivor. Right? There's going to be one portfolio randomly out of the mix that's going to be on the top. And then you're going to be like, listen, he gave 40% per annum. Why couldn't you do it? Right? So as an investor, I think it's a good practice that before investing in a PMS or like a mutual fund, you understand the process. I speak about this, like when we invest in mutual funds, there are very few mutual funds who actually do it with passion. Like for example, the Parag Parekh mutual fund, right? They do it with actual values and principles. It's not like they have multiple funds and, they're trying to market the funds separately. It's like, okay, fine, they have certain principles, they have a process, and they will most likely stick by that process for extended periods of time. And you want to back a fund manager or a mutual fund who has a certain process and sticks by the process. We spoke about this earlier, right? Like where fund managers keep changing and you put faith in the brand, but you don't know if because the fund manager changed, the process is going to change, right?
Okay, so there are two more complaints about PMSs, and I wanted your thoughts on them. One is that you never know about the churn that happens within the portfolio, right? You are not given, you don't know if, like within a 1 month period, 2 month period, whatever happens within the PMS itself. And the second is that when that churn happens, there's that extra taxation that also comes into play. Now, how do you deal with that? Because that is one of the main reasons why people are like, why should I put my money in a PMS when there's extra taxation that happens with a stock churn, when I'd rather just put it in an index fund or say,
a mutual fund.
Or
yeah.
mutual fund, yeah.
I think, so there, I guess, like that communication from the PMS, that this is exactly what we do, this is how we do it, and there is going to be a churn. And what you want to look at is the post-tax return, right? Because you're going to compare to a mutual fund who can churn the portfolio and not pay any tax on it, right? So you're competing on uneven territory. And I think like that communication from the PMS is really important, that listen, this is what we do, this is how we do it. And like more and more transparency from the PMS. And a lot of the PMSs feel like, oh, we can't share so much information because then, where's our edge going to lie? But then if you don't share that information, the investor will be taken aback, right? So I think like that communication is necessary. And you like it or not, if you're a PMS, if a mutual fund is going to give a better return, I will tell the investor, why don't you go to an ETF or a... So even within our PMS, right? Like since we're a quant fund, say for example, like something like a momentum. If I were to run a momentum, strategy within the PMS, I would do worse than a momentum ETF because I'm going to pay tax and he's not. So a lot of times we take exposure through ETFs itself, through the PMS. See, the thought process is that the investor needs to make money at the end of the day.
Correct.
Right. So for example, like,
and make more money than an index fund or a mutual fund.
Exactly. Right. Like I think like a big thing, at least on the quant side, what ends up happening is that timing becomes a very important element of returns. So we end up, I mentioned that we end up owning, say, the momentum ETF. But for us, timing is extremely important. So we did not own it the last 1.5 years. We started owning it, say, recently. When we started in 2024, we realized that, okay, fine, it doesn't make sense to own a momentum ETF because multiples are crazy, valuations are crazy. So that as a quant fund, I feel like we can take all those decisions. We can go through so much data. And come out of the decision a lot faster than say a normal fund. With a traditional PMS, the thing is that from the fund manager lens, I understand like there's so much time that you need to put in just in stock selection that you don't have time for like say other sort of analysis, which is macro analysis and like allocation and timing and position sizing, right?
So what's the, of course, yeah, I totally get that. What is the data suggesting now to you in terms of the markets? Like, because, this has been a long period of underperformance that India has seen versus its peers and versus other asset classes.
So you ask in terms of equities, like are you asking?
Equities, yeah.
So in terms of equities, like the way we are looking at right now is that you would probably achieve nominal growth. See, what matters is real returns, right? Like, and what we've achieved in India is, I think it's nominal returns in terms of the index, Nifty. If you look at mid cap and small cap have done a lot better, but you're doing a lot better because you're taking a lot more risk, right? As we speak, say small caps are down 20% or 25%, right? So you're taking a lot more risk, so you're generating that 18%. With the index at 12%, so if you break down Nifty returns long term, 12% per annum, again, 7-8% is inflation, 3% is currency depreciation, 1 or 2% is corporate alpha. So I know that like a lot of people don't like to listen to something like this because they say, why are you so negative? I'm not negative. I'm just saying this is the truth and let's see how can we do better. So going ahead, because of what's happening with the US now, and I emphasize on this because maybe you and I and a lot of people have not seen this ever. We've always seen the US as a superpower. So we are in this place wherein, things are going to change dramatically. And when they do, owning assets will become really important. So I think whether markets will do well or not, you have to be invested today. You can't sit on the sidelines and think I'm going to time the market. So the follow-up question is, where do you invest in? Like, what kind of businesses do you own? I think the kind of businesses that you want to own are the ones where valuations are really cheap. I think where there is an underlying commodity, where there are hard assets, not the ones and the ones that have a brand. So if the US starts printing money, what's going to happen is there's going to be a liquidity injection into the system, right? When a liquidity injection happens, most consumer brands are able to pass on the price rise in their raw materials to their consumers, right? But for that, you need to have a strong brand. So if you can own a brand, you will continue, like you will see that growth.
So give me some examples of companies that will sort of wade through weather this storm.
So see, like say for example, within the Nifty 50, right? If you're looking at large cap stuff like the Hindustan Unilevers or then stuff like the Hindustan Coppers, which have already done
It
extremely
rallied
well.
a lot. That story has played out, no?
But I don't think so that the story is over.
Okay.
I think we are underestimating what's going to happen in the US. Like I keep emphasizing the US again and again, but we are underestimating what's coming.
So when you say what's coming, it's interesting to me because even I'm following this closely. There is a lot of talk about this whole American hegemony coming to an end, right? And it doesn't happen overnight.
It takes 5-7 years
It
at
takes
least.
5-7 years at least. And if we are in the midst of that, we are seeing signs of it with what's happening with, say, America
Trump
and
and
Venezuela,
tariffs.
Trump and the tariffs, and Canada and China, right? So if the narrative holds that the American hegemony as we know it for the last 20-30 years is coming to an end, is that what you're talking about? And if yes, what's the approach?
I think it's going to happen. It's not a matter of like if it'll happen, it's about when it'll happen. We don't know when it's going to happen. Maybe 1 year, 2 years, 5 years. The fact that Trump is doing all these things. So if you read the Changing World Order that Ray Dalio wrote, right? Like back in say 2015-16, he had mentioned that a time like this calls for a person like Trump. And like he said it way before Trump actually came into power. So he said that like you're going to get a populist, guy, a guy who is not going to cooperate with the world, a guy who's going to try to protect his own interests because now his throne has become shaky because he knows that, like things are going to be uncertain. News is changing every day, right? Market was up 3%, say a couple of days ago because, Trump was favorable. Don't think that the volatility is not going to go away. I think the volatility will continue for a couple of years for sure. He's going to do this. And the reason why he's doing this is because the more uncertain he becomes, the easier it becomes for him to negotiate with the world. Because look at it, there was no tariff. Now we are satisfied with 18%, right? Tomorrow he'll say 19%, you'll say, okay, no problem. You don't have an option. Had he said 25%, we would have been yet happy and markets would have been up 3%. So I think that a time like this calls for someone like him. What you and I need to do as investors, understand that, see, we can't do anything about the world. We can't change these things. What we can do is how we position ourselves. I think positioning ourselves within equities, within, say, gold as a percentage of your portfolio becomes a no-brainer. You're going to see volatility, but live through that volatility because if you sit on the sidelines, you'll become poor without realizing.
Tell me more about that. I know the concept, but I want more people to just know about this.
So, last 5 years, right? Real estate in Mumbai itself, right? Prices have moved from say 25,000-30,000 rupees a square feet to 70,000-80,000 rupees a square feet. And if you look at older buildings, right? Prices have not moved out there. Newer buildings, they move. Reason being because costs have gone up. Older buildings are depreciated. So now, even though I used to own a 2,000 square feet house in Worli, I can't buy a 2,000 square feet house in Worli in a new building. Because costs have gone up. The builder, it's not that the builder is making a lot of money. It's just that costs have gone up and he needs to pass it on. And he's passing it on to the consumer. Now, who's surviving, right? Who are the builders who end up surviving as a brand? Say the Lodas, the Godrej, the guys who end up having that, the brand name and who can pass it on. So when that the line that I said where so that if you don't own an asset, you'll become poor is that the government is going to continuously print money. They will print their problem away. You will not realize they will print their problem away. And because you are not invested in an asset, the value of your money will erode. Right? Like 1 crore today will not be worth 1 crore in 5 years. It's going to be worth a lot less. So the reason why gold has rallied so much is this entire debasement trade where people are not having any more faith in the dollar now. They're saying that if someone's going to do these things, why will I have faith in him, right? To look at the problem from an investor lens, I understand it's a very complicated problem to understand, right? Like, how do you think of all these things? But you look at the country as an individual. So if you look at the US as a guy who's like really, he's taken a lot of loans on his books and but he's really reckless, right? He's taken all your money, he's blown it up on things he doesn't need. Now he's saying that, listen, I have
I
all
need
your
to
money
pay back. Yeah.
and I need to pay back, but I'm going to bully you because you don't have a choice because I own I own your assets. So you look at the problem that way, right? And what happens to people like them? They struggle. It takes time. They'll try all their tactics, but eventually someone will come out on top. It's not going to be a beautiful cycle, but we are going to go through it. But the silver lining in this is you're going to get amazing opportunities. I think you'll see prices where you've not seen earlier. So sitting in safer assets or sitting in even within equities, not looking at, I want to become a 3x in 2 years. Looking at like places where, okay, fine, margin, there's a lot of margin of safety. This is a consumer brand. I can continue owning this. You wait, you'll get that opportunity. Because again, right, like once you're down 30-40% becomes hard to digest.
It does. And I've seen this many times, right? In 2008, in 2020, in the Russia-Ukraine crisis. Like every time you just sort of are trying to enjoy your portfolio and then there's like a 20-30% drawdown.
And then it becomes so hard, right, from an investor perspective. Like, so on our end also, we always say, fine, like capital protection is key, right? If you have the money, then you can make a bet. If you don't have the money, what are you going to bet? Then you're only going to watch TV. Right, so you want to be able to protect your capital. That's
Okay, so you're in your early 30s, right? For people who are trying to build a business like you, trying to perhaps achieve the kind of success that you have achieved at your age, what is your advice to them? Because I know you have certain philosophies, like you follow the Ray Dalio concept of investing, for example. You are very firm that one should not be buying real estate at this age. Maybe invest your money in other maybe liquid assets. So what is your not advice, but what do you want to share with people your age as to how should one really get to where you're at?
I think, like, I don't think so I've done anything like, which you're saying successful and stuff like that. But I would say that, like, I just think curiosity. I think I can be completely wrong about this, this US crisis, and maybe like equities will see a rally. But at the end of the day, you have to take massive action. I can be wrong, and maybe this trade will not play out, and maybe gold will be at $2,500. But if I'm right, at least I had conviction in my idea, because you can only have so much information, right? So I think from an advice or like from an idea perspective, I think like constantly being curious, figuring out what are the other guys doing, what have they done. I think like I'm a very big copycat. I end up just like looking at other people's portfolios and seeing that, like, just to mention.
So who do you track closely in the famous investors, and what is your learning from them? Ray Dalio, of course. Tell me a little more about that, and who else?
I'll give you an example. Like recently, I was looking at 1 year performance of PMSs. Okay, and then there are top 10 PMSs, and very few have done well, right? Because markets have not done anything. And then on top was Equitas, because they were, and I knew that they own gold.
And they had a big
They had like a 80-90% maybe allocation gold. And then there was another PMS, I don't want to name it, but they were like, say, number 4 or number 5. And I was like, okay, fine, what
you
are these
can
guys
name
do?
it.
So it was 2.2 capital. And, I know of them because a friend of mine has invested them, and he always spoke highly about them. And I used to always read they have these newsletters that come through, and I always have been reading the newsletters year after year. 2 fund managers that do it. And they're actually like a 2,000 crore fund or something like that. And as far as I remember, they're a very small team, like a 4-5 member team. And a friend of mine asked them, how do you do this? He's like, we're 2 of us. We pick 3 stocks a year, 1.5 I pick, 1.5 he picks, and that's it. So
in the PMS.
Yeah, in the PMS. They're like,
wow.
So I was like, okay, fine. How did they, how are they on the top? So what we ended up figuring out, okay, fine. What they end up owning, like, say they ended up owning a lot of NBFCs, financials, that ended up doing extremely well. So they were 100% invested in equities and yet up 25% that year. So the idea is that, there is always going to be someone who's better than you. And can we figure out from them what they've done? Another investor I mentioned in the start, say Jim Simmons, right? So he was a quant fund, and he's done like something like a 65-70% per annum for 20 years. And he passed away a couple of years ago, valued at like $25-30 billion. And there's not a lot of information about him out there, but the few videos that you watch of him, he says that since he started the fund when he was 45, he ran it for like a good 35 odd years. Last 20 years, he's done that 70%. He's saying, I've not made one strategy since the fund began. It's all about the people. And he only as a fund manager, he doesn't talk about the markets. He only talks about culture and people, and how people actually made me. And like, how if you empower people, give them the right infrastructure, put them in a, in a safe environment, they'll produce great results for you. And they did that for him. So at Code also, what we end up doing is that we're trying to create a really good team wherein, I don't need to make decisions. If tomorrow, whether I am there or not there, the decision-making process should remain constant, right? There needs to be idea meritocracy, where the right idea wins. Even the junior most analyst should be able to come up to, say, a fund manager and say that, listen, I don't think this is right. Because ideas can come from anywhere, right, Sonia? Like, you can have an analyst who's shouting his, throat out that, listen, this is a good stock, I've gone to the factory, but you think that he's a junior, right? But you have to keep your eyes and ears open, and the best idea should win. So, that's something I learned from, say, Jim Simmons. Even, there's Nimish Bhai, who is like a veteran investor. Not a lot of people know about him. Inam. And, if you hear about him, I think he has a cult. There are this group of people who end up following him, who believe in him as though he's like God. And the reason why they do it is because he cares for his people. Like everyone around him, it's not that he's gotten rich alone. Everyone around him has gotten rich with him. And he makes sure that he carries people with him. So I think these are just the small things that, like I end up noticing about other investors and what they've done right. And like, yeah, that's...
Have you been able to meet or, get mentored by any of these investors? I mean, any mentors that you have of your own, apart from your mother, of course?
No, honestly, like I've not had any exposure in terms of like meeting them. They're probably like YouTube videos that I end up watching of them. And then, like in parts, they end up saying things that, oh, we do this or we do this. And then you try to dissect, how did they get there or what did they do? Like when I hear of like, I have seen like Radhakishan Damani from very far away once, and he's such a simple man when you look at him, right? But if you go through his journey, at the start, he mentions that he has taken so much leverage. There was a day when I forgot the guy's name, but there was that crisis, right? In 1998, Harshad Mehta crisis. He's saying that if one more day the markets would have been, so he was short. And if one more day the markets would have been up, he would have, probably been bankrupt, right? So all of them have a journey. I think like all of them are really passionate. They all have taken exorbitant amounts of risk at some point of time. I don't know whether they are survivors or not survivors, but I think everyone has used leverage in some way or the other.
Yeah, the fact that we're talking about them is that they have survived and they are still relevant in their space.
Exactly, right? But I think like one concept that like a lot of people don't understand is the use of leverage. I feel like a lot of them have used leverage at some point of time in their life.
So tell me a little more about that, how the use of leverage.
If you look at Warren Buffett, right? Like, I mean, I mentioned this that, okay, he's a great stock picker, but that's only 20% the reason why he is where he is. I think 80% of the reason, like, the massive net worth that he has is because of the use of leverage. And it's pretty simple, right? Like he bought an insurance business, he took the float, invested all of that float into equities because that leverage was available at a 0% interest cost. It's like, Sonia, if I can give you a loan at a 0% interest cost and tell you, can you pay me back after 25 years? You'll be like, why not?
Yeah.
So if you look at the
But you have to have that risk appetite also to put that money into a risky asset class.
I don't think it's a risk appetite. I think he knows very well. The thing is that he doesn't speak about it. I think he knows very well. When he started his career back in 1960, that's when the era of the fiat currency began. Look at the kind of things that have come together, right? Like 1972, the president came in and said that, now there's no more need to back currency with gold. And, from there, it's been a one-way curve. He understands all these elements. The fact that he's sitting on, say, a 35-40% cash today means that he's timing the market. Right? The fact that you sit on cash means you're timing the market. Even though his message is very clear, don't try to time the market, I think he means to say that, okay, fine, if you don't have the time to study equities and study the world, don't try to time the market. But he's saying, I'm an expert, I will do this. Right?
He's also perhaps sitting on cash because he's like 90 years old.
I don't think so.
What do you do beyond a point with so much money, right? At some point, you'll have to use it.
I don't think that is like, like the guy remembers all kinds of numbers at that age, right?
Yeah.
Like he'll come into an AGM, he'll be talking about like dividends that he received and, how much cash is kept. So I think he yet has that passion, and sitting on cash is a conscious call. And probably he knows things that we don't, right? And the idea is, can we figure out what he knows? Why is he sitting on a 40% cash?
So, okay, so between now that we've established that it's going to be a very volatile world and things are changing rapidly, and the American system of, say, the petrodollar or even just dollar as a dominant currency may not hold 10, 15 years down the line, right? Between Indian equities, global equities, gold, silver, Bitcoin, everything that there is, where do your preferences lie?
I think like equities and gold. We don't have the reach to get to Bitcoin. I don't understand Bitcoin, the way the currency works, honestly. So maybe not the right person. Global equities, a lot of opportunities out there, like specifically even with China. If you look at like, a lot of allocation happening out there today. If you just visit China once, right? Like just go to a factory and see the kind of, I went once to buy furniture thinking I'll get for cheap out there. It's a lot cheaper. Midnight, 12 o'clock, I called up the factory guy that, I wanted to visit. He's like, yeah, I'll keep the factory open. Don't worry. I wanted to buy just one sofa. But the guy is saying at 12 a.m., he's like, yeah, no problem, come, I'll, maybe like 50,000 rupees or 1 lakh rupees. But the guy is saying, no, that's the kind of work ethic they have. If you're going to get rewarded for this at some point of time, right? And so having exposure out there could be
Do you
great.
invest in the Chinese markets?
Honestly, I have zero exposure outside of India. All the exposure is over here, just from a restriction perspective, right? Like you can't really, put any significant sum of money outside of the country because there are LRS restrictions.
Now you can through Gift City and all. Huh?
You can, but again, it's from an individual, it's restricted to 250K a year. That's like tops. So that allocation can be done. But again, the taxation is also a lot more if you're investing. And also when you're investing, you have to, 20% is the TDS, the TCS that's going to be cut. Right. So it's not lucrative. Like your outperformance has to be a lot more. So then your option is only Indian equities and gold. Right. If you're looking at Indian equities, I think there are like lots of opportunities. But again, in that consumer space, in the commodity space. So if you're playing that and with extremely like good valuations, like I would not put my hands in any of the high flying, high growth businesses today. If you look at you've been in the market since say 2008,
yeah.
right? So if you look at 2014 and 17 were crazy years for small caps, right? 14 and 17 we saw all kind of growth businesses do extremely well, even 2023, 2021. But if you look at what has caused that, the crazy run up, a large part is maybe 50% is liquidity. And that when that liquidity comes in, then you will end up doing extremely well. So we don't know whenever the US starts printing, growth businesses will again do well. But I think like the commodities and the consumers will end up doing a lot better. Having allocation to gold again is something that, we continue to hold just from a cutting off the risk perspective.
So if someone has missed out on the gold rally and wants to allocate now, it's still worth buying gold?
I think as a percentage of your portfolio, yes. So now I'll tell you the problem, right? Like I spoke to someone yesterday, he's like, should I buy gold? I said, see, if you look at gold alone as an investment in your portfolio, there's a problem. You have to look at the entire portfolio as a whole. Problem is that you're not looking at the portfolio as a whole. Then what happens is that like,
people decide that let me switch my mutual fund portfolio to my gold portfolio, and then that's where the mistake happens.
Say, let's take for example, you have 1 crore rupees, put 25 lakh rupees in gold and 75 lakhs is in equity, say in mutual funds or a PMS, whatever. Now, at the end of 1 year, it's possible equities does extremely well, gold is flat. What most people end up doing is, ye bekar hai, let me remove gold and put in equities. See, you need to understand that both of these asset classes are not correlated. There will be periods where gold will perform. There will be periods where equities are going to perform. You're not going to get the upside of every instrument. It's not possible. Right? Most people are feeling bad that they didn't get the upside from gold. But yeah, probably because you were exposed to equities from 2020 to 2024 where you made a lot of money.
Yeah. So asset allocation is the key, basically.
Asset allocation is extremely. I think asset allocation and position sizing is probably more important than stock picking.
So on position sizing, I want to talk about that because for someone and for people who don't know, position sizing is when you have conviction in a particular stock and then you decide to kind of raise your position in that one stock, and people don't do that because they don't have so much conviction. So if they feel, say, a Hindustan Copper is doing well, instead of putting like 500 rupees in Hindustan Copper, their conviction levels are still that, oh, I'll just put 100 and then I'll see, I'll watch it. But how do you kind of develop the skill of position sizing?
I think position sizing is a factor of knowledge. So, like, let's take it really easy. Whose position is the largest in a company? The promoter. Why is the promoter having the largest position? Because he can control the company and he has access to all the information about the business, right? So, he's probably a 70%, 80% owner in the business. Now, then comes the investor. Now, the thing with an investor is that you can only know so much on the outside. So, position sizing becomes a factor of knowledge. Say there are investors who can actually get in touch with the promoter. They speak to the promoter. They get access to factory visits. I'm a small investor. I don't have access to that kind of information, right? Wherein I can actually understand the product a lot more. Say I like the solar sector, right? But I don't understand how a module is made, or I don't understand how a battery is made, or I don't understand how a panel is made. Until I don't go to a factory, it's going to be really hard for me to, get a real understanding. Now, the way we break it up is, I would say that I would rate knowledge on 10 and say that fine, if it's a 9 on 10, my position size can be maybe 10-15% in that one particular business or sector. And if it's say a 1 on 10, it could probably be 1-2%. You have to bet. You can't not bet, right? You can't not bet because there's only going to be so much information. And you have to figure out how to get more and more information. So if you look at anyone who's taken a stake in the business, has probably spoken to the promoter, right? And the reason he's taken a stake is because he has access to information. I'm not saying that this is information that the public should know or not know. It's just more understanding of the business. Where say if you've done a factory visit, you will know exactly how this business works, right? So when you have that kind of knowledge, I think conviction comes from there. So from an investor perspective, idea is to gain
The knowledge, yeah. Okay, fair enough. So you were talking about some sectors, right? For the next couple of years, which are the big themes, the big sectors that you're very bullish on?
I think I'm again the same thing, right? Like consumer goods and everything with an underlying commodity. I think it's a very easy play if you understand the debasement and what's going to happen in the US. It'll become a very easy play for you. Anything else requires like a bottom up approach wherein you actually go understand from the management, right? So if you break up the market, I think like 80% of the companies are in the small micro cap space, right? There are about 5,000 companies, about 3,500 are in the small micro cap space. Out there, you have to have, if you want to take a large part of your portfolio, you have to have access to information which is not, I would say, easily available, but you have to go and meet the management, because without that it becomes very hard unless it's an institutionalized business. So for an example, right, like if you are to invest something like in a 361 or an IIFL, it's an institution. You don't need to actually meet the management to understand the business. You can understand the product and it's very easy. But any B2B business, any manufacturing setup, you'll have to understand, from the management. So I think there is no particular sector out there. I think that, once you start doing research, you'll figure out, okay, fine. Now, something that we've been doing research on recently is transmission lines. And we've been understanding that, okay, there's a big requirement that there are enough solar plants out there. Maybe the solar, we've already seen the, solar rally. But, transmitting electricity is a very big play out there. There are a couple of businesses out there that are doing it well. And especially in the, the high power transmission, like above 400 kV, 500 kV, that's where the applying of the line is yet left. The government is spending a lot of money. But see, all of this requires like in-depth research. Just giving out a stock's name and then, someone buying that stock is like, would be silly. Even I wouldn't be able to do something like that.
Yeah. No, fair enough. Okay, interesting. So your all-weather PMS is by and large, you follow the principles of Ray Dalio investing style, right? Tell us a little bit more about that. And, what kind of, I don't want to talk about returns, but on an average, like over the next 2-3 years, what is your hope with this PMS? Like what kind of returns can it generate?
I think like there's no prediction in terms of returns. The idea is complete. Like with all weather, the idea is that you want to have a portfolio that sees very low drawdowns. So every PMS tries to optimize, or try to optimize for CAGR. How do I make 20%? How do I make 25%? For us, the idea is how do I have good risk-adjusted returns? How do you measure risk-adjusted returns? Like, can you put a number to it? See, since we are a quant fund, we want to put a number to everything, right? So a good way to look at it is we look at this ratio called the return divided by the drawdown. And when I say drawdown, I mean, say, you started with 10 lakh rupee portfolio. It went to say 15 lakh rupees. Now it's come down to say, from 15, it's come down to say 14. So that 1 lakh rupee that you lost, so 1 divided by 15, right? Say 6-7% is a drawdown that you have seen on your portfolio from peak to trough. Now, the number that we are tracking is your return divided by the drawdown. So say, we did a 25% return with a 5% max drawdown. So that means that there's never been a time from the peak of your portfolio, your portfolio should not have fallen more than say 5-6%. So that number, that ratio is what we end up tracking. Our objective is that even if you make 12% per annum, can you make it with a lot lower risk? Look at the Nifty, it's done 12% per annum. Look at the risk that you're holding. 2008, you lost 57%. I don't think that's in any way it makes sense, right?
But that's true. But the argument is, and I know you are biased because you run a PMS, but for someone who is just looking to protect their capital largely and get on an average 12-14% returns, that's something the Nifty has given you in the last, 2-3 decades.
So, but we
right?
can do it a lot better, right? Like I mentioned, if you add gold to your portfolio, forget the last 3 years. I know like a lot of people say, oh, gold has done last 3 years. You go back and look at gold year after year return.
But then you can buy gold separately also, gold
So
ETFs.
don't do it in the PMS. Absolutely not a problem. I'm saying that like you don't need to. Like when an investor comes to me, I'm saying don't do it. Do it yourself. The problem with doing it yourself is that it's not your full-time occupation. Very well you can compare, one fund to another fund. And you will say, oh, he did 18 and you did 16. I think the thing is that like you didn't achieve that 18, right? You achieved the 16. Now you don't know whether you'll be able to, live through the Nifty cycle. You'll be able to live through a 25% drawdown. When the idea of giving it to a PMS or a fund manager is that at least, you don't have the headache of
the stress of
managing that. If it's a full-time occupation, go ahead and do it. I don't think there's a problem out there. So, even within the PMS, we get this, we have a problem because we end up owning a lot of ETFs within the PMS. We don't end up owning stocks, and at least in all weather. And a lot of investors will be like, but you're owning ETFs and, you made your money in gold. But I'll say, see, we took the call, right? At the end of the day, whether it was luck or whether it was like skill, very hard to differentiate. But we had to take the call. We took the call, If you
and
think
the call went right.
And it went right. So it's, I think it's a part. So even last whole month, we saw gold falling like maybe 30% or 25% from peak. But our portfolio did not see more than a 6% drawdown.
Okay.
Because of the way we structure the portfolio. So I think that's the skill that a fund manager needs to bring on the table, right?
No, absolutely. Now, I take your point. I mean, for someone like you who's now in the building stage, right? I mean, it's not even been 10 years since your PMS.
It's been just a few years.
It's just a few years. So you still have to see many cycles.
Absolutely.
Which is what investing teaches you, that you will not learn how to be a good long-term investor until you don't go through those cycles, right?
Absolutely. I mean, see, I get it a lot of times that, you're so young, you have not seen a cycle, the day you lose like a large part of your capital, you'll understand. I'm saying that, I understand and that's going to happen. It's a part of, growing your business, being an investor. But at some point of time, if not late, at some point of time, you need to have conviction, right? You need to understand that you're not going to have all the understanding. Right? I can't wait for the next 15 years to get that conviction. I think that's where Quant plays a really good role, wherein that if you can study history, right, then maybe I don't need to live through the cycle. Yeah, living through the cycle definitely will, really. For example, I saw maybe 2018, 19, 20 where small caps were, went through a really bad phase, and I had exposure to small caps. Maybe drawdowns were like 50-60%.
What did you do back then?
So I used to run so I'll tell you how I started in 2016. I read this book called The Little Book That Beats the Market. And it was written by this guy, Pat Dorsey. And what he did was that something called the magic formula. And what he did was he took two ratios, return on capital employed and EV by EBITDA. And he combined both the ratios, ranked all the businesses that were listed and bought the top 30 businesses. And he did this year after year. And in the US, he did something like a 20% per annum in the fund. And so I ran a back test. I took all the India data, and I had learned how to code. So I created like 20 years of data. And
what is a back test, by the way? I'm sorry, I'm very bad at coding, so I don't know anything about coding. So this is all new to me.
So I'll just talk about Quant. Okay, what is Quant? I'll tell you what it is not. It is not a black box. It is not like some code that you have written and it's going to pop out and throw up some stock. It's just a set of rules. Right? It's simply a set of rules. I think the most, I would say like the most simple or the most stupid quant model is the Nifty 50. Right? Nifty 50 has 50 businesses. How are those 50 businesses coming into the portfolio? Based on market cap. So the larger the business, it's going to come in the top 50, right? Based on free float market cap. So it's a simple quant model. Once in 6 months, they churn the portfolio. So once in 6 months, one business or two businesses come out and a couple of businesses come in. Now, if you think of it, something so silly, where there is no fundamental factor, there is no promoter judgment, has done 12% per annum, then can't we make something better? right? Can't be put in some fund. Like what if, with the Nifty 50? So this was the thought process. What if with the Nifty 50, I could only buy businesses where return on capital was good, where, they have, say, a 2-year profit track record, right? So maybe that will do better than the Nifty 50.
So what is the quant model that you're using now?
So right now, outside of all weather, we also run another strategy called the growth fund, which I started back in 2017.
Okay.
And the idea was that looking at return on capital employed, promoter holding, age of the promoter. So like, promoters between the age of say like 40 to 55 have done significantly better. So all this data, like this is alternate data that you end up collecting, and then you try to, see like
which are the companies that fit into those.
Yeah.
So you said return on equity, age of the promoter, and corporate governance.
No, corporate governance we do through like free cash flow. So there are multiple different parameters. Every parameter is given a weightage. The highest weightage is always given to return on capital employed. See, this is like math, right? If you know that a promoter can, has great capital allocation skills and can generate 20% return on capital year after year, the stock will do extremely well. Right. And if you break down a business, everything depends on return on capital. In the long term, any 10-15 year journey, you will see that the return on capital of a business will match the return on the stock price. If you look at the Nifty 50, 12% per annum, long-term returns. Look at EPS growth, 11.95. It's almost like, the same. And it will converge at some point of time. So if there's a big gap, then you know that there is going to be some sort of convergence at some point of time. So taking a look at all these different parameters, working capital, so all sort of fundamental stuff, no price, right? All sort of fundamental stuff. You put that in, buy the top 30 businesses, churn that just once a year. So you're paying only long-term capital gain tax.
So a couple of final questions. When you do put these quant model, certain parameters into your model and you get a list of 10, 15 stocks, what happens when the world order, when there is volatility globally and when there is a huge macroeconomic shift, how does that feature into your quant model?
So I'll tell you, within the PMS, what we end up doing is asset allocation is on top. Where you want to allocate, when do you want to allocate, sort of is the decision maker. So say this quant model only picks up like small and mid cap businesses. Last 1.5 years, only 5 to 7% of investor money was allocated to this strategy. So when we are running the PMS, the thought process is that allocation becomes very important. Even if someone say like, Sonia comes and says that, listen, I don't mind being aggressive. I have experience. I have seen 2008 and I don't mind seeing a 50% drawdown. I'll say, Sonia, I understand where you're coming from and we'll get there, but maybe not today. Today we'll start with an all-weather. Let's allocate maybe 75% of your capital to the all-weather portfolio because of where markets are and 25% to the small cap portfolio. There will come a time wherein, we will shift your portfolio, but not today. And asset allocation becomes a key play out there. So a lot of investors, even I would want to be a small cap holder. I know that like a lot of wealth is made out there, but I think timing becomes key out there. If you only run one small cap fund, problem is that the moment you're having capital inflow, you have to allocate capital out there, even though if it's not a lucrative time. So the idea is that, this is what Siddharth Bhaiya did, right? He did it so well. He took that call, moving from a micro cap fund or a small cap fund to 100% or large allocation to gold was a bold move. But that's what paid off, right? So the idea is that can you actually allocate? You'll be wrong sometimes. And I know I'm going to be wrong sometimes. I'll be right sometimes, but that's fine. That's a part of the game. And I'm okay to be wrong. I think it's a part. So that's what we end up doing. We end up allocating at the right time. Right time according to us, but it's not going to always. Idea is that can you be right 6 out of 10 times, 7 out of 10 times? If you do that, then you're successful. I don't think investors are worried about like, that guy did 20 and you did 18. I don't think people really fuss about it. The idea is that, if you're able to beat the market consistently over a 3-5 year period, then you'll be fine.
Then you're good to go.
Then you're fine, yeah.
Rishabh, it was really a pleasure speaking to you. And, it's so refreshing to hear your thoughts because as someone, and I completely agree with you when you say that, a lot of people must be telling you, you're so young, you've not seen many cycles. But there are pros and cons of being a young investor, right? The cons, of course, are that you've not seen many cycles, but the pros are that you approach everything with a very fresh perspective and you are ready to take those risks. You are ready to adapt to the changing world world order. And you don't have that so-called hubris, right? Because something has worked for you for 20 years, you're not saying that, okay, it's going to work for the next 20 years, and you're not refusing to change. So I think that's a great positive for you. So keep going and all the best. I'm sure I'm going to have you on my show a lot more to discuss specific topics. But thank you so much for being on the Money
Thanks,
Mindset.
thanks, Sonia. Thanks for having me.